Americans owe $1.25 trillion on their credit cards right now. I want you to actually sit with that number for a second before I tell you it's already wrong. Not wrong because it's fake. Wrong because it's out of date. By the time you're watching this, that figure has already grown. I'll get to the real number in a minute, and it's worse than the headline. But first, I want you to picture something specific. A woman named Maya, 34 years old, marketing coordinator in Ohio, household income around $61,000 a year. She is not irresponsible. She has never bought a designer bag she couldn't afford. She drives a 9-year-old Corolla. Her biggest financial sin, if you can call it that, was a $2,800 emergency room bill after a car accident that her insurance didn't fully cover, plus a few months where rent went up faster than her paycheck did. She put it on a card. Then, 4 months later, her landlord raised rent by $175 a month with 30 days' notice, and the gap between her paycheck and her bills widened just enough that a second, smaller charge landed on the same card before the first one was anywhere close to paid off. She has been paying the minimum every single month since. She thinks she is being responsible because the payment clears and the account stays open. She has no idea what that decision is actually going to cost her in real dollars over the rest of her life. By the end of this video, you will know exactly what it's costing her in real dollars, and you'll know if it's already happening to you too, because the odds are higher than you probably think. Here is the correction I promised. That $1.25 trillion figure is Federal Reserve Bank of New York data from the first quarter of 2026. It's real, it's accurate, and it was already falling as consumers paid down their holiday spending, which happens almost every single year in the first quarter. But the New York Fed released its second quarter report on August 11th of this year, and credit card balances didn't keep falling. They climbed by $21 billion in 3 months, back up to $1.26 trillion. That's just $17 billion short of the all-time record $1.28 trillion set at the end of last year. So the honest headline isn't that Americans have $1.25 trillion in credit card debt. It's that Americans came close to paying that down and then went right back to the highest level ever recorded in the history of this data set, which goes back to 1999. I'm not telling you this to be pedantic about a rounding difference. I'm telling you because the direction of the number matters more than the number itself. And right now, the direction is up. Let's talk about who actually owes this money, because Americans as a category hides more than it reveals. According to Federal Reserve survey data, only about 47% of credit card holders carry a balance from month to month. More than half of cardholders pay their statement in full and never pay a cent of interest. This video is not about them. This video is about the other 47%, the people for whom a credit card stopped being a payment tool and became a loan they didn't apply for. Among that group, the average unpaid balance sits around $7,900, and the average balance across all cardholders, including the ones who never carry debt, is $6,610 as of this year, according to TransUnion. Break it down by generation, and the picture gets more specific. Generation X, people roughly in their mid-40s to their 60s, carries the highest average balance of any generation, around $9,600, driven by mortgages, kids, and aging parents landing on the same household budget at the same time. Millennials come in second. Baby boomers have actually been paying their balances down. Gen Z carries the least, around $3,500, mostly because they've had credit the least amount of time, not because they're inherently better with money. And here's the detail that matters most for the story I'm about to tell you. 55% of the balances people carry aren't for vacations, electronics, or impulse purchases. They're for groceries, rent shortfalls, medical bills, and car repairs. This is not primarily a story about bad decisions. It's a story about a gap between income and cost of living that a piece of plastic quietly fills and then charges you 22% a year to have filled it. Now here's the part nobody explains clearly, and it's the actual engine of the trap, the average interest rate on a credit card balance that's actually accruing interest, meaning a balance someone is carrying month to month sits at 22.15% as of the second quarter of this year, according to Federal Reserve data. 22% isn't just high, it's a rate that makes minimum payments almost decorative. I ran the actual math so you don't have to trust a vague claim about compounding and just take my word for it. Take Maya's situation. She doesn't have the $7,900 average. Let's use a clean, round $5,000, which is close to what a lot of people are carrying after one bad year. Her card uses the standard minimum payment formula most major issuers use, 1% of the balance plus that month's interest with a $35 floor. If Maya pays exactly the minimum every single month, without ever missing a payment and without ever adding a single new charge, it will take her 16.4 years to pay off that $5,000. Not 16 months, 16 years. And over that time, she will pay $7,731 in interest on top of the original $5,000. Her total cost to borrow that money is $12,731. She will have paid more in interest alone than she originally borrowed, minus about $1,000 for a debt that started the size of a used motorcycle down payment. I want to be very clear about why this happens because it's not a trick, it's arithmetic. Early on, almost her entire minimum payment is being consumed by that month's interest charge. On a $5,000 balance at 22.15%, the first month's interest alone is about $92. Her minimum payment that first month is only about $142. So barely $50 actually reduces what she owes. As the balance slowly shrinks, the required minimum shrinks too, because it's calculated as a percentage of a smaller number, which means the interest charge and the principal reduction stay locked in an almost even fight for over a decade and a half. This is why financial counselors call it the minimum payment trap. It's not that people aren't paying, it's that the structure of the payment is designed, whether intentionally or not, to keep the balance alive for as long as legally possible while extracting the maximum interest along the way. Now, let's put a different version of Maya next to the real one because the fix here isn't complicated, it's just uncomfortable. Same $5,000 balance, same 22.15% interest rate, but this version pays a fixed $200 a month instead of the shrinking minimum. That's roughly what a lot of households spend on 2 or 3 streaming subscriptions, a few takeout orders, and a couple of forgotten subscriptions combined. At $200 a month, the same debt is gone in 2.8 years, not 16. Total interest paid $1,768 instead of $7,731. That's a difference of $45,384 in interest saved and 83.8 years of her life not spent making a payment to a bank for a debt that should have been closed in her early 30s. I want to say that number again slower because it's easy to let it slide past you. $45,384. That's not a hypothetical. That's the actual computed difference between two people who owe the exact same amount of money to the exact same bank at the exact same interest rate, and the only variable that changed was how much of the minimum trap they refused to accept. Before we go further, I want to explain why 22% even exists right now. Because it wasn't always this bad, and understanding the mechanism matters more than memorizing the number. Credit card rates are tied to something called the prime rate, which moves in lockstep with the Federal Reserve's benchmark interest rate. Back in early 2022, the average credit card rate sat around 14.5%. Then the Fed raised rates aggressively to fight inflation, and card issuers, most of whom priced their cards at the prime rate plus roughly 12 to 13 percentage points, raised right alongside them. By August of 2024, the average rate across all credit card accounts hit an all-time record of 21.76%. Rates have pulled back slightly since then as the Fed has trimmed its benchmark rate a few times, but they've barely moved because banks got comfortable at this level and issuers are in no hurry to compete it back down. So the person carrying a $5,000 balance today isn't paying 2019 interest rates. They're paying rates that are roughly 6 full percentage points higher than they would have been 6 years ago, on top of everything else that got more expensive over the same stretch. That's not Maya's fault. That's monetary policy, set in a boardroom in Washington for reasons that have nothing to do with her rent, landing directly on her statement anyway every single month, whether she understands why or not. Let's talk about scale for a second, because it's easy to think of 22% interest as somebody else's problem. If you take the roughly 47% of Americans who carry a balance, and you apply that average accruing interest rate to the portion of the $1.26 trillion that's actually generating interest charges month over month, the math works out to somewhere in the neighborhood of $130 billion a year in credit card interest alone, flowing out of household budgets and into bank revenue. That's not rent, groceries, retirement contributions, or emergency savings. That's money leaving people's lives permanently for the privilege of having borrowed money they often needed for groceries in the first place. Divide that out and it comes to roughly $360 million a day, every day, in interest charges alone, nationally. Here's where I have to push back on the easy narrative, because if I don't, this video is lying to you by omission. The delinquency numbers look genuinely alarming at first glance. The share of credit card balances that are 90 or more days past due jumped from 7.6% to 12.8% in a single year, which sounds like a crisis. But the New York Fed researchers were explicit on this point in their August release. Much of that jump reflects a change in how long charged-off debt stays visible on credit reports, not a sudden collapse in people's ability to pay. By 2024, roughly 80% of charged-off balances were still showing up on credit reports a full year later, compared to about 40% in the 2004 to 2012 period. Strip that reporting change out, and new delinquencies, meaning debt that's freshly falling behind rather than old debt lingering on a report, have actually held close to steady since early 2024 at just under 7% transitioning into delinquency over a rolling year. That's still elevated. It's not a 5-alarm fire. I'm telling you this because financial content that only ever tells you the scariest version of a statistic isn't informing you. It's just recruiting your anxiety, and I'm not interested in doing that to you. This isn't distributed evenly across the country either, which is worth knowing if you've ever felt like your own debt looked worse than what you read about online. Cardholders in New Jersey carry the highest average credit card debt of any state, according to LendingTree's analysis of hundreds of thousands of credit reports, with Hawaii, California, and Alaska close behind. All high cost of living states where the gap between income and rent is widest. West Virginia sits at the opposite end with the lowest average balances in the country, not because people there are better with money, but because there's simply less high cost spending pulling balances upward in the first place. The lesson isn't that people in expensive states are worse at budgeting. It's that credit card debt tracks cost of living almost as closely as it tracks income, which is exactly why this problem hits hardest in the places where wages haven't kept pace with rent. And generationally, the pattern tells its own story. Generation X, roughly ages 45 to 60, carries the highest average balance of any generation. And it's not because they're reckless. It's because they're the textbook sandwich generation, often paying a mortgage, helping aging parents, and covering a kid's college costs in the same month, sometimes the same week. Millennials are close behind, still catching up financially from graduating into either the 2008 crash or a brutal early 2020s job market, depending on their exact age. Baby boomers have actually been paying their balances down in recent years, largely because their major expenses, mortgages, kids are mostly behind them. And Gen Z, despite constant headlines calling them financially reckless, actually carries the least debt of any generation with access to credit, mostly because they simply haven't had a credit card long enough to accumulate a large balance yet, not because they're inherently more disciplined. Their balances are, however, growing the fastest of any generation year over year, which is the trend actually worth watching over the next 5 years, especially as more of them age into the exact life stage, rent, first cars, first real jobs, where a single unplanned expense tends to land hardest. Let me answer the 2 objections I know are coming, because ignoring them would make this video less useful, not more balanced. First, doesn't paying more than the minimum hurt my credit score? No, it does the opposite. Your credit utilization, how much of your available credit you're using, is one of the biggest factors in your score, and paying down principal faster lowers utilization and typically raises your score over time. The only thing that hurts your score is missing payments entirely. Second, what about a balance transfer card instead of just paying more? That can genuinely help, and I'm not going to pretend otherwise. Moving a high interest balance to a card offering an introductory 0% rate, usually for 11 to 21 months, can save real money, provided you can actually pay it off before the introductory period ends and provided the transfer fee, typically 3 to 5% of the balance, is smaller than the interest you'd otherwise pay. It's a legitimate tool. It is not by itself a substitute for the underlying math we just walked through, because if the habit that created the balance doesn't change, a balance transfer just moves the trap to a new address for a year or two before the same interest rate eventually comes back. What I am interested in is the part of this story that doesn't get talked about enough, which is what economists are now openly calling the K-shaped divide. The New York Fed used that exact language in their own research alongside this report. It means the aggregate numbers, the trillion-dollar totals, the national averages are hiding 2 completely different economies happening at the same time under one roof. In higher income zip codes, delinquency is actually improving. People there are increasingly able to pay their balances in full, use cards for points and cashback, and treat revolving debt as optional. In lower income zip codes, the opposite is true. Delinquency is climbing, balances are stickier, and the credit card has quietly become the emergency fund that almost half of American households don't otherwise have. The debt service ratio, which measures how much of household income goes toward paying down debt, sits at 11.2% nationally right now, up from a pandemic-era low of 9.1%, and climbing. That's still below the 15.8% peak we saw right before the 2008 financial crisis. We are not there yet. But the direction, again, matters. It's been rising for 5 consecutive months. So, who does this actually apply to, and who is it not really about? If you pay your statement balance in full every month, this entire video is close to irrelevant to your actual finances, beyond understanding what your friends and family might be dealing with silently. If you're carrying a balance because of one bad month, a medical bill, a layoff, a rent increase that outpaced your raise, this isn't a referendum on your character. 55% of the debt we're talking about exists because of necessities, not indulgences. But here's the honest, slightly uncomfortable truth I have to include, because leaving it out would make this video dishonest by omission the way I already called out the delinquency stat for being. Once the emergency is over, if the minimum payment habit continues out of comfort rather than necessity, that's the moment the trap stops being about the emergency and starts being about the structure of the payment itself. That's the moment Maya's math applies to you, whether the debt started as an emergency or not. Let's recap the real numbers, because you should be able to walk away from this with facts you can actually use, not just a vibe. Total credit card debt sits at $1.26 trillion as of the second quarter of 2026, not 1.25, and it's $17 billion from an all-time record. The average interest rate on a balance that's actually accruing interest is 22.15%. 47% of cardholders carry a balance month to month, and the average unpaid balance among them is around $7,900. A $5,000 balance at that rate, paid at the standard legal minimum, takes 16.4 years to clear and costs $7,731 in interest. The exact same balance, paid at a fixed $200 a month, takes 2.8 years and costs $1,768 in interest, a difference of over $45,000. 55% of carried balances are for necessities, not luxuries. And the debt service ratio, the broadest measure of how squeezed American households are by debt payments generally, has been climbing for 5 straight months and now sits at 11.2%. Up from a pandemic-era low of 9.1%, though still meaningfully below the 15.8% peak recorded right before the 2008 financial crisis, which is the closest thing we have to a historical worst-case marker for this particular number. Here's the actual takeaway, and it's not never use a credit card, because that's not realistic advice and you already knew that going in. The takeaway is that the minimum payment on your statement was never designed to get you out of debt quickly. It was designed to keep the account open and the interest flowing for as long as the math legally allows. That's not a conspiracy, it's just the incentive built into the product. The version of Maya who added an extra $100 a month wasn't smarter than the version who didn't. She wasn't luckier. She didn't have a better job or a richer family. She looked at the actual math instead of the minimum payment on the statement, and she made one decision once that compounded in her favor instead of against her, in exactly the same way it had been compounding against her the entire time she didn't look. The number on your statement isn't the whole truth. The rate next to it is. That's the number that decides whether the debt you're carrying is a temporary bridge or a permanent tax on the rest of your life. Look at that number today. It's sitting right there on your last statement, printed in small type near the bottom, usually with a sentence that says something like, "If you make only the minimum payment, it will take you approximately this many years to pay off this balance." Most people have never actually read that sentence. It's not hidden. It's just easy to skip past when it's sitting next to a payment amount that feels small and manageable. It isn't small. It's the slowest, most expensive way to borrow money that's still technically legal. And now, finally, you know exactly what to do with that number.